So you've seen us do a couple episodes on seasoning. We're going to bring that all together with the investor strategy that is called BRRRR. So let me pull that up real quick. So it stands for buy, renovate, rent, refinance, and repeat, or some variation there. So the idea here is we want to get our investors into distressed properties, whether that means a fix and flip loan or a DSCR loan to purchase something that may not quite be at its full potential. They're going to fix that property to its full potential. They're going to rent that property at market rent to its full potential. And then they're going to refinance that property based on the repairs and or higher rents. So this is just a way to kind of package what investors always do, right? Investors are always buying and fixing or improving or increasing rents. That's always an investor's goal. But this is kind of more putting it all in one strategy. And it's a catchphrase that you hear a lot out there. So you're going to buy properties with either a fix and flip loan or a DSCR loan typically. You're going to renovate either with the fix and flip loan or just cash. You're going to rent them out at market rates. Then you're going to refinance that property, get your cash back out, and do it all over again, repeat. So that's what it stands for there. So hopefully that's a good intro there for you, Jose. And Jose is going to talk about how it comes together with the purchase and then the refinance later. You got to have both strategies in mind when you're talking to your investors that want to use this strategy, right? It's a double-ended strategy. You have to have the entrance and the exit all happen within typically 6 months or less typically. So Jose, hopefully that's a good intro. I'll let you go ahead and take over and show your examples.
Absolutely. Would have been great if some of the audience, and maybe they were on last night's show where we were talking about internal rate of return and your ROI, the return on your investment, because that's one of the critical components when these loans, the fixed flip loan, are getting priced out. So what we're talking about here is taking the investor through the whole process. It starts with their purchasing the property that needs rehab, right? They're going to better the property, they're going to rent it, and then they're going to refinance it, get their cash out because they're going to refinance it at the current market value. That's the key component here, right? They're going to refinance it at the current market value as soon as possible, preferably as soon as they're done with the rehab, right? They may actually start the application a couple of days before they got that CO just to get everything going. Just make sure that when you order the appraisal, that the rehab is complete, right? Because unfortunately, we've had people jump the gun and they're like, "Yeah, but I'm good for it. I'm almost done." No. It has to be done, or else you're going to get an as-is appraisal. I mean, you're going to get a subject-to appraisal instead of an as-is appraisal. Subject-to meaning subject-to repairs, and then the appraiser is going to have to go back out to the property, another trip, another cost, $150, $200, right? Plus a delay, 3, 5, or 7 days to the process. So these are all things that should be discussed with the investor as part of our consultation. Now, let's discuss some of the terms that we're going to talk about here. One is as is value, right? The as is value, that's the pretty much the value that they're purchasing it for, right? If it's a purchase, if it's a refi, that's the current value of the asset, right? The season or the ARV, right, is the after repaired value. That's the value of the property, obviously, after the repairs are completed. Now, that it's important you reach out to your realtors to give you good market analysis. Maybe you have an appraiser that you can reach out to who can give you some solid comparables of recently renovated properties within close proximity, similar style and gross living area as the subject, right? You're not going to compare, even though your property may have been renovated, you're not going to compare a 1950s home to a 2024 home because there's just going to be too many style differences, right? The newer home's going to have bigger closets, bigger bathrooms, family room, huge eating kitchen, whereas the older home is going to be more compartmentalized and all of that. So that's not going to work either. Seasoning, right? Another important phrase. And again, like I like to state, we're not talking about salt and pepper here. We're talking about seasoning on title by the current owner, right? So This is for the refinance, right? That's going to be the key component here to consider. What is their seasoning on title? In most of these cases, their seasoning on title, which is how long they have been an owner of the property, is going to be less than 6 months, unless it's a really heavy renovation. Then it may be more than 6 months. But ideally, they want to do anywhere from 1 to 3 months. They want to be in and out as soon as possible. If it's just a light rehab, kitchen, remodel bath, kitchen, and some paint, some appliances, that shouldn't take more than a month or two maximum, unless you run into the situation that you're waiting for some materials that are on back order or something, and it's a critical component and you can't put everything else together until you get that one piece. That's an item to consider. And then, like I was mentioning, your return on your investment, also known as your cash on cash return. That's a key component for the rehab part, because you're not going to get that renovation loan unless there's a good ROI. Some of them use a benchmark 30%, right? Now that is going to vary from conduit to conduit, but just keep in mind the ROI on the flip is the income, right? They don't use borrower personal income. Doesn't matter if the borrower makes $1 million a year. If the ROI on the flip is 10%, you're not going to get any fixed flip loans. They're going to say, I'm sorry, there's not enough meat on the bones. Maybe put more down payment or structure the deal a little differently, and maybe they'll see a different ROI, but it's just not going to work. So, key things to consider there, as I show you here, because the deal is they're going to fix it. And then if their strategy is to fix and hold, as is the strategy of many of the flippers, they're going to hold it by refinancing that flip loan or fixed flip loan into a DSCR loan, preferably one with 0, 3, or 6 months of seasoning, examples of which I have all for you. And another thing to consider is going to be the experience level of the investor for that flip loan. We have 0 investor experience options, but things get much better if they have at least 3 flips under their belt in the last 3 years. And by that, their track record has to be directly related to them. They have to be the owner of the flip, right? They have to have been in the LLC when it was purchased, when it was renovated, and when it was sold. And you will have to provide documentations, closing statements of the purchase, closing statements of the sale, and operating agreements to match, to make sure that everything reconciles. So that's key components here. So let me get into the examples that I have here for you today so you could visualize this a little better. This example here, I have a 0 experience flipper, right? But he has good credit, 740 credit score, and there's a little meat on the bones, so we're getting 75% LTV, 100% of the rehab, and it works out to 82.78 loan to cost, which is pretty good. In our example here, we're looking at $150,000 purchase price of the as is asset, right? And the initial draw on that loan, the initial distribution, is going to be 112,500, which is 75%. That means that the borrower is going to have to come up with 25% down because they have 0 experience, right? But since there is good meat on the bones, they are going to deal with them. So you can see right here, loan to cost, 82.78%. Our interest rate for this borrower is 11.49%. And in our deal here, so you can see the setup, it was $150,000 purchase price, which is the as is value, $75,000 in rehab, and an after repaired value of $350,000. Gross profit on the deal, $123,505. So you see there the 82.78% loan to cost, which is very good, and 53.57% loan to ARV. Right now, there are limits on those. So if the ARV was lower and the There is a limit on the loan to value on the ARV, but in this case, we are way under. And the one that's going to restrict this is going to be the loan to cost, which we're still good here, right? So this is for our flipper with zero experience. Now, getting the same exact scenario, but just changing the flipper experience to 3 in the last 3 years instead of 0. Everything else remains the same. Now you see that we get 85% loan to value on the purchase, right? So our purchase of $150,000, loan amount initial distribution $127,500, down payment $22,500. So we're getting 85% LTV on the initial purchase, which is awesome. We're still getting 100% of the rehab. And look at this, we're getting 89.41% loan to cost. That's pretty amazing. In the overall scheme of things, a borrower is really coming in with 10.59% of their own money to do this deal. Remember, this is much better than maxing out your credit cards and then lowering your credit score and then not being able to do anything, right? So here's the deal, 10.49%. Also, the rate drops by 1% due to the extra experience of the flipper. If the ROI maybe was a little bit more, maybe that would change, but we're pretty much maxing out for this particular conduit because that's a lot of profit on the deal, right? Gross profit. Oh, and here's the ROI. Remember, I was mentioning to you 30%. The ROI they're factoring on this deal, 35.29, and actually on the other deal, 35.29. So that's the same. Now, keep in mind, interest rate really does not make shouldn't be the deal killer in these scenarios. So that has to be made clear so that you don't go down that rabbit hole with the borrower and then lose the deal because they were so focused on the rate instead of the loan to cost, the loan to value, and the distribution, their experience or lack of, and all the components that could affect the deal. Plus, remember, this is a short-term loan. In this case here, this is 12 months. So what's going to be the difference if it's an interest-only payment between 10.49 and 11.49, $100 a month, something like that? Not a really big deal. So this is the initial stage, right? So then now the investor comes to you and says, okay, Jose, we're almost done. We're ready for the end loan to refinance out of this construction loan, essentially, which is what it is, right? Now, obviously, you being the good consultant that you are, you would have discussed this with the borrower at the inception of the process, because always when we're talking and consulting our fixed flip investors, we always need to also speak about the exit strategy, right? One thing is, okay, you can purchase the asset, but what's the exit strategy? Is the exit strategy to sell, or is the exit strategy to hold? So in this case, we had already discussed with our investor the exit strategy, and the investor told us, Jose, I'm going to get this done in 45 days, right? So that investor wants a 0 month seasoning. But the investor also told me, Jose, I'm already paying closing costs for this transaction. So I want to maximize the benefit of my investment in this transaction by being able to get the maximum cash out so they could have a little bit more money available for their, the next deal, right? They may not want to have to get as much from the flip loan or whatever it is plans they have for their money that they want. So in this case, we do have 80% LTV, 0 month seasoning. And this is, apples to apples here. This is a lender paid comp here in this rate. And the borrower is paying 1 point loan discount to get 9.625 30-year fixed rate loan, 80% LTV, right? So now you can buy it down more if you want, but this is a pretty good option there. 9.625, 80% LTV is actually an amazing option. Cash out no seasoning. Very limited options on a 80% DSCR cash out, and much less with no seasoning. Very, very limited. So now this is now another 0 months seasoning on title option, but this is 75% LTV. So in this case, our investor still wants the no seasoning option, but does not need to max it out because they want a better rate, right? They plan to hold the asset for a bit. So look at these great options here, right? 9%, lowest cost option. So it's lower rate than the other one, but substantially, even at 9%. And if we compare the 1 point cost on loan discount, it would be right here, 8.75 at 1.025, where the other option was 9.625 at 1 point, right? So it's about 0.875% lower in rate to go 75% LTV as opposed to 80%. Now, another reason you may go 75% LTV instead of 80 is maybe you couldn't get the DSCR to work, right? To be above 1.0, because it is minimum 1.0 DSCR required for this program. So this is 75% 0 month seasoning. So now, if the investor said, no, Jose, I'm going to have to redo the bathrooms and we also got to put a roof on it. I don't think we're going to be ready in less than 3 months. So what other options do you have? Okay, well, we have a 3 month seasoning option where this is a DSCR option where we can show rehab of the property after purchase. They will let us go 3 month seasoning. Now, there is a maximum loan amount on this option of $750,000, I believe, but still, that will definitely include the majority of the flip loans or refinance from a flip to a DSCR that you would be doing. And look at these rates. Amazing, right? 8.25, and now this is 75%. 3 month seasoning, 8.25 is your lowest cost option, and look at that, right? You can buy that down all the way to 7.125, right? So good option here. And now 6 month seasoning. Now I could have shared the same 3 month seasoning option for you at 6 month seasoning, but I just wanted to share a different option here because it has a lower rate as the lowest cost option, right? But as you go down the rate sheet, it doesn't get as good. But if the borrower doesn't want to spend as much, you're looking at 7.875 costing 0.15, whereas this option was 8.25 costing 0.15. And then you can buy that down all the way to 7.25%, right, for your 6 month seasoning. Now, we do have a 12 month seasoning option, but that doesn't appeal to the investors. And really, the rate is not any lower for that option. It's just a different conduit that treats their DSCRs a little different. So again, 0 months, 3 months, 6 months DSCR, and the fixed flip loan with zero experience and with 3 flips in the last 3 years experience. So very good option here to be able to take your fixed flip investors through the whole process. And this is what you should be doing when you are consulting them over their project at the inception of the deal. You're going to lay all the cards on the table, and then basically it's a go.
All right. I don't see any questions here, surprisingly, but definitely a good strategy to use and something that's very exciting. If you do your research on this, you'll see all kinds of groups out there and discussions and all kinds of videos out there on the BRRRR strategy. So definitely something good to familiarize yourself with. All right. No questions. So we'll go ahead and wrap it up then. Remember, 11 a.m. Eastern, every single weekday, we do this show where we pull up our actual live rates and then we do a deep dive into a different topic. Were you going to say something else, Jose?
No, I'm good. Thank you.
Okay. All right. So thank you, everybody, for tuning in. Thank you, Jose. Great presentation. We'll see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live.
We got a last minute question that came in.
The question is, with seasoning, we have loan products with seasoning ranging from 0 months to as high as
12. I mean, really, with when you're considering seasoning, though, what's most attractive is zero, right? 0 month seasoning is what's most attractive. That's why we covered 0 months, we covered 3 months, and then we covered the more standard in the industry 6 months. Now, I did mention 12 months is also out there. There's a couple of the conduits.
That's conventional, right? Too, if you want to go conventional, 12 is the only ticket, right? So
Absolutely. Yeah, true. If you do have that full dockable investor that insists that they want conventional for different reasons, maybe they can go full dock and they don't want a prepayment penalty. Could be probably one of the only reasons there at a good price. Then that would really be the only reason. But as you saw from the rates Nick was posting, DSCR is beating agency, especially when you're looking at a cash out refi on an investment property, is beating agency all the way around.
All right. Well, we'll see everybody tomorrow at 11 a.m. Eastern. Everybody take care. Have a good day.